InvestSMART separately managed account benefit number 10. From $5,000 to $50 million and beyond, everyone is able to take advantage of our outperforming investment team. We aim to take away the barriers to entry when it comes to investing, be it through the language we use when writing our recommendations, to the minimum investment amounts. Investing is for everyone. You just need to start. For more information, visit investsmart.com.au or download our new app.
Hello, I'm Tony Kaye, I'm the editor of Eureka Report. Today I'm talking with John Maroney. He's Chief Executive of the Self-Managed Super Fund Association. Welcome, John.
Thank you, Tony. Pleasure to be here.
John, just wanted to talk about you coming into the role fairly recently, and what are the key things that you're focusing on?
Yeah, thanks, Tony. Yes, it was a pleasure to start in the role last month, and lots of challenges. And it's a very exciting area because there's a lot of growth and a lot of interest in self-managed super funds. But there are challenges, and I'm happy to go through some of those with you.
Yeah, I'd like to ask you, what are the key challenges that SMSFs are facing?
So the most recent one that's been added to the list is a report from the Law Reform Commission on elder abuse. And this is an emerging risk, not one that's immediately there, but there are a lot of members of self-managed super funds in their 50s and 60s, and they'll be progressively moving into their 70s and 80s over the decades ahead. And there is an area of reducing mental capacity, and that potential risk of losing capacity to look after your own affairs well means people have to plan well in advance, and we think there's some good recommendations there from the Law Reform Commission, and we'd like to see the government act on those recommendations.
So what are some of those recommendations?
One is to have the investment strategy of the fund take account of the need to plan for the potential loss of capacity, and so that there is a thought given to enduring powers of attorney, so that somebody else can help look after the affairs of the self-managed super fund and other aspects if the need arises, but to plan for that in advance.
Estate planning is a really important part of running an SMSF too, isn't it?
It certainly is, and particularly the changes to the cap. So there's a $1.6 million cap that comes in from next week, 1st of July, and that makes it more important for trustees and beneficiaries of those self-managed super funds to have good estate planning in place, wills, enduring powers of attorneys, etc., binding death nominations, and to have those in place as early as possible.
Probably the biggest thing that I see, and you probably see as well, is just in terms of making your funds last. Life expectancies increasing, and just having enough money really in the kitty, and to keep things going.
Yeah, no, that's very important, and it's a key part of what the funds are there to do, is make sure that there is adequate income in retirement, so that all retirees from self-managed super funds and more broadly can live in a secure and dignified retirement. But that does take money from the fund and from the age pension for most people, and a lot of people will live into their 80s and many into their 90s. And if you do live into your 90s, you really do need to plan for a 30-year sort of period of drawing down progressively from your super fund, age pension if you're eligible for that, and that does take much advanced planning and looking at spending patterns, etc. And that's a very important area for all super funds.
So do you think on a whole that SMSF trustees are putting enough into their super?
I think most probably are, but many would need to put in more, and generally the workforce needs to save significantly more than the superannuation guarantee to have confidence there'll be enough there in retirement. So we would like to see the increase in the superannuation guarantees planned over the next decade, but also to encourage people to know what their own personal needs are, because most people will need to save significantly more than what their employer puts in to ensure they have a secure and dignified retirement.
I suppose the rule changes that have come in for the new financial year point to the ability for people to salary sacrifice more easier, which is a good thing.
Yeah, that's a real benefit from the changes. So that means everyone will be able to salary sacrifice up to $25,000 a year, including their superannuation guarantee contributions in that limit, and that's a much more flexible system than the one we had before. So that's a great benefit, and there is also a good opportunity for most people to put in significant amounts of non-concessional contributions from their own savings, particularly as they get close to retirement, but also in the earlier stages.
Well, John, thanks very much for joining me today. It's been a pleasure having you here.
Thanks very much, Tony. Pleasure to be with you.
Thank you.